Okay, on slide number 36, we have an example of how we book non-controlling interest and non-controlling interest equity, both from the standpoint of the company in question, which is Walmart in this example, and then also from the standpoint of the non-controlling shareholder. So let's take a look at how each of these would be presented in the financials. In the top table, we have retained earnings presented as a decrease, retained earnings decreased by income or loss attributable to the parent's shareholders. So we have a beginning balance of retained earnings of 68 billion in this case for Walmart. To that, we're going to add net income, we're going to subtract dividends and other adjustments, and we're going to have an ending balance of retained earnings of 72 billion. In the second table, we have the equity of non-controlling interest, which began with a balance of call it 4.4 billion. We add to that the net income attributable to the non-controlling stake, which was 684 million. Other adjustments of 265 for an ending balance of 5.3 billion. And you can see here that presented on Walmart's balance sheet as what would amount to an increase in this case of 5.3 billion. So total Walmart shareholders equity, that would be the equity that's associated with basic or fully diluted shares outstanding, and then in a separate line item here we show non-redeemable, non-controlling interest of 5.3 billion. Okay, again, for our purposes here, since we're focusing on the interest of the company that's attributable to basic shares outstanding, the controlling interest of the company, we need to factor in and make adjustments for non-controlling interest in our return on equity calculations, or just otherwise be aware of the impact that will have on all of our ratios. And like we talked about a moment ago, time series analysis as well. So just make sure that you're excluding non-controlling interest from return on equity. Okay, let's move on to learning objective 3 and talk a little bit about equity carve-outs and convertible debt. When you hear the term equity carve-out, I want you to think about a company getting rid of or divesting from a business interest of some kind. Maybe this is an operating unit of the company or a separate company that they had bought in a prior merger and acquisition activity, maybe an overseas operation, and for whatever reason management has decided that their business would run more efficiently or be higher valued by the Wall Street community perhaps if that business were no longer a part of the mothership. And there's several ways that a management team can go about effecting a transaction like this, and we're going to look at 3 different examples. The first of which is called a sell-off, which is exactly what it sounds like. And in this example, we're looking at United Technologies in a transaction that they initiated in 2002, whereby they basically sold off a piece of their business. I think this was Hamilton Sunstrand. And the important points that we need to be aware of is that at the time a company announces that it intends to divest of a property, they no longer record that property in ongoing operations. They will now record the income from that property or from that business unit as discontinued operations on their income statement. And then when they do sell that business, any gain or loss from the sale of that discontinued operations will similarly be differentiated on the income statement. Okay, so that first divestiture was called a sell-off. Very simply, a company is just selling off a business unit, and the points that we need to be aware of there are the denotation of that as a discontinued operation. A spin-off is similar, but instead of selling a unit off to a private equity firm, for example, we are rather going to distribute that business to shareholders in units of newly issued stock in a separately traded company. So imagine, if you will, one day you log into your Fidelity or Schwab or TD account and you notice shares of, in this example, Beam Inc. So you see shares of Beam. And on the next day you log in and now you see your the same shares of Beam that you saw yesterday, but now you see this new home security company and it's got its separate ticker. You may be unfamiliar with it and you don't know what it is. Well, the Beam had simply engaged in a spin-off transaction, and these spin-off transactions, because of that little dynamic, because of the newly created stock, they can be a very profitable place to invest in the market. And that's on account of some forced selling pressure that typically accompanies a spin-off by very large mutual fund organizations that may run large cap mutual funds, for example. If you own a large cap value or large cap growth mutual fund and one of the companies that you hold inside of that fund engages in a spin-off, then your charter may not even allow you the ability to hold that company. And it's usually a very, very, very small portion of the total mutual fund. So managers are inclined to sell it. And that's typically what you see with a spin-off is forced selling pressure 30 to 60 to 90 days right out of the gate. That can and typically does drive a spin-off's valuation below its fundamental economic value. That creates opportunity, and as a result, historically, spin-offs have been a very profitable portion of the market to play in. Moving on to slide number 43 here, we're looking at that Beam spin-off in a little bit more detail. Basically, this is just accounted for. We count for a spin-off just like a dividend, where we will reduce retained earnings and you can see that down here, the spin-off of Fortune Brands. We adjusted the proportional share of accumulated and other comprehensive income, retained earnings, and non-controlling interest. So any of those amounts that are associated with that particular business unit are just decreased from the statement of shareholders' equity. Now let's look at an equity carve-out in the form of a split-off. So think of a split-off as basically a stock buyback done as a barter transaction whereby a company will buy back its own shares in exchange for interest in another one of its business units. So a company is bartering this buyback transaction where it's buying back its own shares, but instead of buying back those shares in exchange for cash, it's now buying back those shares in exchange for an interest in another one of its business units. And in this example, it's a publicly traded business unit whereby I think it was Sanofi bought back some of its own stock in exchange for shares of Mead Johnson. So we simply adjust the treasury stock account for those balances in that instance. But I really just want to direct your attention to the differences between sell-offs, spin-offs, and split-offs. That's what I want you. That's what I want to hold you accountable for in Module 8 here, is knowing the differences knowing the features of, and knowing how to differentiate between a sell-off, a spin-off, and a split-off. So just direct your attentions there as you're studying for and reviewing for Module 8 in advance of a test. Okay, convertible securities. We talked about convertible preferred stock being a negotiated term that you might see in association with a preferred stock that allows a preferred stock shareholder to potentially participate in the upside of a preferred stock issuance. And specifically, we talked about Warren Buffett's engagement of Dow Chemical in 2008. Convertible features can also be associated with debt, and in this instance we're looking at a senior convertible debt issue by Xilinx that had an accompanying convertible feature. So in this example, we're going to issue debt in the amount of $600,000, and when that debt is converted with this particular feature, that transaction is shown below, whereby we would reduce the long-term debt account for the principal value of the debt outstanding, in this case $600 million, and we would increase the equity account, in this case, 198 million in par value or common stock, and then the additional or plug figure, as we have reviewed several times, becomes additional paid-in capital. At the time, that's a when and if that debt is ever converted. Very similar, as I mentioned, to the convertible feature of a preferred stock. And these types of features can be very, very attractive, very, very common for companies that want to issue stock and or preferred debt or preferred stock and convertible debt, that feature can oftentimes lead to a lower interest rate. So that can be very attractive for a company, a chief financial officer that's trying to manage its short-term cash flows in the most effective way possible. Okay, and lastly, with regard to Module 8, just always some notes on global accounting. You can see here the differences between US GAAP and IFRS. Nothing of particular magnitude that I will call out here. I'll just direct your attention to those last couple of slides, and just direct your attention to the text as well as you study for the exam. So that is Module 8, and please feel free to hit me up with any questions that you might have via Blackboard or email if any of those topics just didn't resonate or are confusing after reviewing this material, the material in the book, as well as the material on our class website that has additional videos, by the way, and also our online class text. So just recall all those. Those are all resources available to you at your disposal. Use them. They're very helpful, and let me know if I can help further. So thanks a lot. Appreciate it. Take care.